This I'm sampling this from roughly second week in December or whenever it was that we finished the course to date. And again, as I said in the beginning, it's just to give students a taste of what you can do with the material you have learned in the course, and to help people bridge that gap between knowledge acquisition / skills mastery and actually executing trades in the market to get results. So in total, for this period from the second week in December to date, we took 7 trades in total. These are all the trades: CAD yen, CAD Swiss, Euro pound, pound yen, Kiwi yen, CAD yen, UK oil. And of all of them, 6 of them were short trades. 1 of them was a long trade. I guess students all know what that means, but if you're not a student and you're listening, short means selling, long means buying. And these are the dates we took them. So between that period, 7 trades in total. So what are the facts there? So of all the trades, 6 of them were wins, 1 of them was a loss. So, and these are the results there. So plus 1.4% for CAD yen, negative 1.0% for CAD Swiss. So that was a loss. Plus 4.98% for Euro pound, plus 1.86% for pound yen, plus 0.4% for Kiwi yen, plus 1.5% for CAD yen, and plus 1.5% again for UK oil. So out of that, 6 wins, 1 loss. This loss here, that's negative 1.07. That's losses are typically for us 1% and no more. But the way this happened was when I was initially going to take the trade, I think I entered some wrong exit prices or wrong order sizing, or both, one of the two. But there was a manual error there, which caused the trade to close immediately. And obviously, you guys know or may not know, we trade through brokers, and once you get into a trade, the broker has already taken their cost of that trade. And for as long as the broker has taken the cost and the market has not yet moved to either your entry price or even beyond your entry price in your favor, the trade will still be running at a loss. So immediately the position closed, it closed for a very, very tiny loss there. So that is why this is more than -1. That's why. So when the trade was taken properly, the loss from the trade was 1%. So considering everything together, so this makes for an 85% strike rate. Strike rate, you remember from the course, is the percentage of your wins to the total number of trades that you've taken. So if in this case, 7 trades in total, 6 wins, 1 loss, 6 by 7 is 85% approximately. So what does that mean? And I guess I'll come back to what the implication of that strike rate is. Or maybe I should just say it now. So you'll remember from the course that from our perspective, a strike for you to be remotely profitable, especially if you're just taking normal kinds of trade that give you 1% or a little more than 1% in profits. Anything from 62% and above is what you need to break even to make a profit. Okay, so strike rates from 70, mid-70s and above, that's pretty good, very, very good. And if you're getting those kind of strike rates, whether you're trading the short-term positions like these ones here that are maybe 1.4, 1.5, those short-term high strike rate type of trades, you'll be in profit. Or even if you're taking the high reward risk type of trades like this one, then you'll be in profit as well. So all in all, the total profit was 10.57% net. By the time you add all the profits and deduct the loss there, the total profit for that duration of time was 10.57%. So that's all well and good, but there are some important lessons I think we need to consider. And number one is, within this period, from the second week of December to the third week of January, for example, within that period, there were a total of 37 possible days of trading, right? 35 days. I've already excluded the bank holidays that were in December, etc. So 35 days that you could actually take trades. And within those 35 days, there were only 7 trades taken. And even when you look at it closely, you'll see there were 2 trades taken on December 22nd. That's the pound yen here and the CAD yen there. Both trades were taken on the 22nd of December. Now, That then means that in reality, we only actually took trades on 6 out of those 35 trading days. So that's less than 10%, okay? And so what that means, or rather a little more than 10%, but definitely less than 20%, right? So what that really means is of those 35 trading days, every one of those days, we would fire up our charts, look at the market, see if there's anything interesting. And in reality, for you to get this kind of strike rate, to be able to get this kind of profit, in reality, it means when you look at the markets, most of the time, for the limited number of strategies you'll be trading, most of the time there won't be a fantastic entry, or there won't be a fantastic trading opportunity most of the time. And I'm saying that because as you guys have, as at least the students in the room, as you guys have finished the course now, one thing you want to be very careful about is when you do start trading, you don't feel the need like that you have to trade every single day. You don't have to. That's just not true. So the success factors play out when you realize that you visit the markets every day. So 10 o'clock, which is about 90 minutes from now in London. So 10 o'clock when the market closes, you want to be in the go to the market, go to the charts, check everything. Is there anything that meets the kind of strategy you trade? If there is, great, then you can trade it. If there isn't, you just move on. And you'll also remember in the course that everybody knows. Yeah, everybody knows the fantastic trades. You should take them. Everybody knows that. And hopefully everybody knows those horrible trades that don't make any sense whatsoever. You shouldn't trade them, okay? But the one I find that most people struggle with are those trades that are, just about okay. You could justify it as a good trade, but you could justify it as a bad trade. So they're those trades that are just okay. And they may have a good number of positive factors for the trade, but they also do have a reasonable number of negative factors for the trade. So it's not the kind of trade where you can write 8 reasons for taking it and maybe only 1 for not taking it. That's a brilliant trade. Or the kind of trades where you can write maybe 4 reasons for taking it and another 3 or 4 reasons for not taking it. That's just about average. And the name of the game is you want to avoid those kind of trades. If you want to make money, really speaking bluntly, you don't want to be wasting your time taking those kind of trades. And the reason there is sometimes they will turn into a profit, and sometimes they will turn into a loss. In other words, those kind of trades can easily yield losses as much as they can yield profits. So at the end of the day, you don't have any strong kind of edge to be taking that kind of trade, meaning at the end of the day, you're just doing all that work, taking positions, and at the end of the day, you're neutral or negative. But, excuse me, your broker is making money from all those trades you take, right? So big lesson here. You don't have to trade every day. Look at the markets every day diligently. Look at all the currency pairs. If there's something that stands out to you, take it. If it doesn't, if it just looks just about okay or maybe ordinary or it's just messy, then stay away from it. You don't have to take it, right? So now this doesn't mean that even though I only took 7, there were only 7 trading days out of the 35 in which I actually traded. It doesn't mean I caught every trade that I would have liked to trade. Okay, so did I miss out on some trades? Absolutely, yes. There were some trades that either I just couldn't be in the charts on the day, or for whatever reason I just missed out the opportunity, or maybe I saw it, for example, and I was waiting for a particular entry signal, and the signal just didn't manifest itself, and the position just took off running in the predicted direction without giving us an opportunity to take the trade. That also happens as well. So it doesn't mean that you can't be profitable if you miss some trades. It's a simple fact. You will miss out on some trades that you should take, but you just need to know, as long as you're taking the trades that you should take and you're consistent with it, then you'll be fine. So missing trades, it's a fact of life. It happens. You just need to accept it and know that even if it may annoy you or put you off momentarily, you just need to know it's not the end of the world. Okay, so those are the should I say learning points for these kind of trades. So now let's review some of these trades in a bit more detail. So if we look, give me 1 second, please. So if we look here now, so this is one of the trades. That was the CAD Swiss, the very first trade that we took. And so if we look at this, and I believe this is the one that turned out to be a loss. I'm comfortable talking about losses because, I mean, losses don't faze me, right? So if you look at this trade, so this was the daily chart, and if you've been through the course, this is how we analyze it. If you're on the call and you're not a student and you've never been through any kind of trading education before, this is all going to sound like Greek, but at least you get to see the process we follow. So my rationale for taking this was very simple. Price had decelerated, as you can see here, around the 0.76 line. Let me go back, so good. Around this 0.76 line here, price had decelerated around that point. And when it was decelerating there, you could see it eventually formed this high test or shooting star, a very bearish reversal candle. In the lessons in technical analysis, I'm not sure which particular lesson it is, but in module 2, where we talk about candles specifically, this is a very strong reversal candle. So I saw it decelerated towards that point, formed this strong reversal candle. This line here, this horizontal line, had been rejected once, twice, 3 times, and 4 times over there. So decent, reasonable reasons to consider it over there. And furthermore, it had been running up for so long that it hadn't really pulled back, made any significant kind of pullback. It had been running up for so long, so I thought, okay, let's have a look at it and consider the intraday charts, which is what we're looking at here. So if you look at this now, this is the 4-hour chart. Okay, what we looked at earlier was the daily chart. In this 4-hour chart over here, so around that 7.76 point over here now, we can then see a pattern emerging. So again, in the technical analysis lesson where we teach price patterns, you'll recognize that this is a type of rise and wedge price pattern, right? And a rise and wedge, you'll remember from the lessons, is a bearish reversal pattern, right? So it's a kind of price pattern that transforms a previous bullish trend into a bearish trend. So I saw that there, drew my lines in. So once price broke out of this this rise and wedge, and I could also see the MACD divergence going on there. Once it broke out of it, I thought, yeah, good, entry signal there, ready to go short, and I went short there. And let's even look at the 1-hour chart and see what happened. So the same rise and wedge over here, and immediately price broke below this rise and wedge over there. I went short there with the stop over there and the profit target over here, right? Also, we can see the MACD divergence is also there, and we could also see there was a lower high that formed over there, and we saw a strong bearish engulfing candle happen over there. So those were the reasons for taking that trade. So price moved, consolidated and moved sideways for about 2 days or so, until eventually it just went in the opposite direction and took out the position for a loss. Okay, so everything there, looking at it still today, would I have taken it? It agrees with everything that I look for when taking a trade. It's just one of those trades that happened to be a loss. Okay, so next one here that I'll analyze for people is the Euro Pound long, which was taken on the 20th of December in 2016. So I guess this is the last trade I'll be talking about today. So if you guys have any questions, please be preparing your questions now, so that I'll just dive straight into it after analyzing this pair. So remember, just have them in mind, be prepared with what you want to ask, so that once we come out of this, you can hit the Q&A button and just post your question in there straight away. I imagine if you try to post it now, you won't be able to see the shared screen, but I'm just warming you up to have your questions handy. So then, if you look at this price chart here, so this is the daily chart for the Euro Pound. And so what's happening here is we could see price form this higher high, higher low, then formed this higher high here, but didn't form a higher low. It collapsed all the way here and formed an equal low essentially. So this, if you try to imagine when price comes all the way up here, okay, the kind of price pattern you expect will form there is what's called a head and shoulders pattern, right? And a head and shoulders pattern is a bearish reversal type of pattern. But price hadn't pulled up there at all, okay? So what I saw was after price rejected this 0.837 line, and we can see the rejection here, here, the third one here, and the fourth one here. That's the fourth rejection of this 0.837, right? Horizontal lines, technical analysis, module 2, one of the lessons, we treat that extensively. So if we look at that now, and you'll just notice that price had rejected this 4 times at least, and here it formed what is essentially a double bottom. And a double bottom, you remember, is a bullish price action pattern. Again, price patterns, module 2, lesson 2, fully treated there. So if you look at this, you formed this double bottom, and down here you could see that there was a MACD divergence there. So price MACD was forming higher lows, and this is a double bottom. So it's diverging positively relative to the price action over here. And so when I looked at that, and I just saw, and I also saw the deceleration here. The deceleration here, pretty fantastic, pretty perfect. Slows down. Oops, let me go back. Slows down pretty significantly there until it forms this very strong low test candle here, and then forms an inverted hammer, another inverted hammer. By the time I saw that, I was pretty convinced. Even so, I hadn't entirely made up my mind yet to take this trade, because I mean, what if it doesn't move all the way up there to form a head and shoulders pattern and just collapse straight down here? Okay, that was a possibility, right? So, but when I looked at this and I saw that deceleration, saw the low test and 2 inverted hammers, I was getting pretty confident. And then I looked at the 4-hour chart, same pair, 4-hour chart. You can see here there is a double bottom there, then a higher low, then another higher low. And you can see here there are these 2 trend lines that had been broken and retested. Okay, so again, I fully expect this looks like complete Greek to anybody who hasn't seen the markets before, but this is just a system that we follow, and that's what trading is like, right? If you are seriously considering a career in trading. So I looked at this, saw that higher low, saw the MACD divergence here again on the 4-hour chart, and by the time I saw this, once this higher low formed with this very strong low test candle over here, which also incidentally formed around the 61.8% Fibonacci retracement. Fibonacci is taught in the last class in module 2, that class titled Annotations and Indicators. Fibonacci is the first thing we treat extensively there. So module 2, lesson 5 is where Fibonacci is taught. So this is 61.8% Fibonacci, meaning it's corrected. Whatever price action went up there corrected itself quite deeply there. And so once I saw that, I was even more convinced, to go along there. So I then looked at the 1-hour chart. So this is all the same type of price action. Looked at the 1-hour chart, saw something that looked like, an inverse head and shoulders pattern there, and saw a series of higher lows there. And by the time we look at this section of the chart, we could see here, this is an ascending triangle that's being formed over here. So once I saw this ascending triangle, I just eventually, I didn't even end up taking it across, all the accounts that we have. I just took it on a limited number of accounts. So eventually went along there, put my stop here, and set the target to coincide with this point here. And that target there, if you go back to the daily chart, I was targeting somewhere around here, right? In case it came in and then it formed like another double top here after forming a double bottom, okay? So that's what I eventually did. Put the stop there, put the target over there, and this eventually closed for about 4.something%. So those are 2 trades fully analyzed, and that's just an example of the trades that we're taking. These are all the other trades. Obviously, if I want to analyze everything here, we're not going to leave here for another 45 minutes, but those are the trades, and this is the breakdown that I've just shown everybody. So on that note, I'd like to then start taking any